The number arrived without warning, printed in formal typeface on official diplomatic letterhead and transmitted through established government channels from United States to Canada. It was not framed as a suggestion, it was not described as an opening offer, it was not floated anonymously to test political reaction. It was issued as a demand. $2.8 trillion. The document, attributed to the Office of the U.S. Trade Representative, stated that the sum was owed by Canada as compensation for what the President of the United States, Donald Trump, described as decades of unfair trade practices. The language was formal, the tone was uncompromising, the number was staggering. There was a fundamental problem with demanding $2.8 trillion from Canada. Canada's entire economy, every paycheck, every corporate balance sheet, every export shipment, every government program, every service provided across a vast nation stretching from the Atlantic to the Pacific produces approximately $2.3 trillion in a full year. That is the gross domestic product of the country. That is everything. The demand exceeded that total by roughly $500 billion. In practical terms, the President of the United States was asking a G7 ally to produce 120% of its entire annual economic output and transfer it south of the border as payment for trade relationships both countries entered voluntarily more than 3 decades ago. It is difficult to overstate the scale of the request. If Canada liquidated every dollar generated in a year, every salary, every business revenue stream, every provincial and federal tax collection, and handed it to Washington, it would still come up $500 billion short. This was not a rumor, it was not a leak, it was not anonymous speculation, it was a formally transmitted diplomatic communication demanding $280 billion per year for 10 years. That annual payment alone would amount to roughly 12% of Canada's entire GDP, meaning that for a full decade, 12 cents of every dollar the Canadian economy generated would have to be diverted to the United States. The letter reportedly warned that failure to negotiate in good faith would trigger the most severe trade measures in the history of U.S.-Canada relations. The $2.8 trillion figure was broken down into 5 categories. Each category, upon examination, raised more questions than it answered. First, $1.2 trillion for historical trade deficit remediation. The argument was straightforward on paper. Over 30 years, the United States had run cumulative trade deficits with Canada. Therefore, Canada owed the difference. The problem is that a trade deficit is not a debt. When American companies buy Canadian oil, lumber, aluminum, or agricultural goods, they pay for those goods. The transaction is completed. Both parties agree to the price. Both parties benefit according to their own calculation. The record of that transaction, if it results in the United States importing more than it exports, becomes a trade deficit entry in statistical tables. It is not an unpaid invoice. It is not a line of credit. It is not money borrowed and left outstanding. It is a record of voluntary exchanges between private actors across a border. Treating a trade deficit as a bill that must eventually be repaid is akin to demanding reimbursement from a grocery store because you chose to shop there frequently. Second, $600 billion for resource extraction compensation. The claim was that Canadian energy, minerals, and timber had been sold to the United States at artificially suppressed prices that harmed American producers. Pause on that. For years, the administration of Donald Trump has publicly criticized high energy prices, calling for increased production and lower costs. Yet the demand now asserted that Canadian oil was too affordable, that the United States had been injured by buying energy at prices deemed insufficiently high. The contradiction was obvious. If energy is too expensive, consumers suffer. If energy is too cheap, producers complain. But to demand compensation because a trading partner provided affordable supply purchased by American firms, strains logic. Third, $500 billion for currency and trade practice penalties.
The allegation was that Canada manipulated its currency to gain unfair advantage.
Canada operates a freely floating exchange rate. The value of the Canadian dollar fluctuates in global currency markets based on supply and demand. This structure is not controversial. It has been acknowledged repeatedly by the International Monetary Fund. It has been confirmed in reports issued by the U.S. Treasury itself. Accusing Canada of currency manipulation contradicts public findings already published by American authorities. Fourth, $300 billion for infrastructure damage remediation. The argument was that Canada's retaliatory trade measures had disrupted American railways and supply chains, causing economic damage that required compensation. But those retaliatory measures were responses to tariffs imposed by Washington. In other words, Canada's countermeasures were triggered by American trade actions. To demand payment for consequences that followed one's own policy decisions is a circular argument. It resembles a scenario in which someone initiates a dispute, faces retaliation, and then demands damages for the retaliation itself. Fifth, $200 billion for national security compensation. This category was the most ambiguous. No detailed accounting was provided. No specific threat was itemized. No quantified harm was clearly documented. The sum appeared as a rounded figure attached to a broad invocation of national security, a term that has increasingly become a catch-all justification in trade disputes worldwide. Added together, the categories totaled $2.8 trillion. The reaction in Ottawa was swift. Within 6 hours of the demand's transmission, Prime Minister Mark Carney held a press conference. His resume is unusual for a political leader. He previously served as Governor of the Bank of Canada and later as Governor of the Bank of England. He holds a doctorate in economics from Oxford. He spent years addressing finance ministers and central bankers in measured tones about inflation targets, interest rate corridors, and systemic risk. At the podium in Ottawa, he brought one visual aid, a bar chart. On one side was Canada's annual GDP, approximately $2.3 trillion. On the other was the American demand, $2.8 trillion. The latter bar was visibly taller. For a moment, he said nothing. The visual comparison communicated the core issue without commentary. Then he began speaking, without teleprompter and without prepared notes. On the trade deficit claim, he explained that deficits record completed exchanges, not unpaid obligations. On currency manipulation, he cited international and American reports confirming Canada's floating exchange rate. On resource pricing, he noted the irony of condemning affordable energy while demanding lower energy prices domestically. On infrastructure damage, he observed that countermeasures followed initial tariffs. On national security, he asked for specific evidence of a defined threat. He delivered a line that immediately circulated through global financial circles. This demand is not an economic proposal, it is economic fiction, and Canada does not negotiate with fiction. The response from Omaha was also notable. Warren Buffett, chairman of Berkshire Hathaway, reportedly remarked that he would be embarrassed if his company's legal team sent a demand letter of similar structure to one of its subsidiaries. Coming from one of the most respected investors in the United States, the comment carried weight. It suggested beyond politics, the economic rationale of the demand was being questioned within America itself. Some analysts proposed a strategic interpretation. The demand may not have been intended to be accepted. An impossible request guarantees refusal. The refusal can then be cited as evidence of intransigence, justifying escalation. In recent months, trade tensions had already intensified. Tariffs were imposed, Canada retaliated, freight volumes declined, American rail networks reported strain, grain shipments slowed, energy projects stalled, factories in border states adjusted schedules. Each stage of escalation seemed larger than the last. Hundreds of billions, then nearly $1 trillion, now trillions. Yet on the ground, practical challenges remained unresolved. Rail bottlenecks persisted, agricultural producers awaited clarity, energy infrastructure negotiations were frozen, consumers in certain states faced elevated fuel costs. Against that backdrop, the $2.8 trillion figure appeared detached from immediate operational realities. Diplomatically, the demand had implications beyond North America. Trade negotiators in Europe and Asia observed the episode closely. When a leading global economy frames cumulative trade balances as retroactive debts, it alters expectations about how future agreements may be interpreted. Canada's public rejection, articulated through economic reasoning rather than rhetorical escalation, positioned it as measured and methodical. The contrast between a numerical impossibility and a calm statistical rebuttal influenced perceptions in financial markets. The central question remained simple: what problem was the demand designed to solve? If the objective was to rebalance trade flows, tariffs and targeted negotiations are conventional tools. If the objective was political signaling, the scale of the number ensured attention. But if the objective was operational, to restore rail capacity, unblock energy agreements, and stabilize supply chains, the path forward required policy adjustments, not invoices larger than a partner's entire economy. In rural regions where rail cars sat idle and grain storage filled beyond capacity, the debate was less abstract. Farmers needed functioning transport, manufacturers needed predictable input costs, energy companies needed regulatory certainty. Numbers in the trillions make headlines, but trains move based on contracts, schedules, and infrastructure. As the press conference concluded in Ottawa, Prime Minister Mark Carney reiterated that Canada remained open to serious negotiation. The word serious did significant work in that sentence. It implied that proposals must correspond to economic reality. The underlying mathematics had not changed. A country producing $2.3 trillion annually cannot transfer $2.8 trillion without exceeding the total value of everything it creates. That is not ideology. It is arithmetic. The episode left a broader lesson about scale and credibility. In international economics, numbers convey intent. A realistic proposal invites counterproposal. An impossible demand invites dismissal. Whether the $2.8 trillion figure marked a negotiating tactic, a political maneuver, or a miscalculation, it underscored a principle understood by central bankers and trade ministers alike. Sustainable agreements are built on shared definitions of reality. Escalation may generate headlines, but resolving trade disputes requires something less dramatic and more difficult: policies that align with economic fundamentals. Until those fundamentals are addressed, the trains remain delayed, the supply chains remain strained, and the headline number, however large, remains only that: a number.